Traditionally, quality is a question of sector, and you will see most managers exclude sectors by principle that are supposedly not quality sectors, typically basic resources like materials, energy, very often financials, and a good chunk of the industrials as well. We tend to have a different approach, which is not top-down when it comes to assessing the quality of company, but we'd rather do a bottom-up approach, which means that we look at every single company in every sector in our investment universe and have this view of course, quantitative aspects, which are very easy to define. When you have your criteria, you just screen on Bloomberg and you get all these quality measures that you want. That can be leverage, it can be margins, it can be free cash flow, profitability, and so on and so forth. But there's also a qualitative aspect of quality, which is very important, and this one is more subtle. It's a question of, first of all, the reliability of the management when it comes to the earnings report. Does the company and does the management have a transparent and very clear way of publishing and disclosing earnings, outlook, guidance, and also does the company and the management give a clear message in terms of guidance that we can, as investors, follow easily. And if there's any change in the meantime between the earnings announcement and the next publication, we like to have an information about that from the management. And all companies don't do that, some do. It's very important. And then in terms of qualitative aspects, you can have a look inside the balance sheet and the big items of the balance sheet of a company, typically the treatment of goodwill, the stability of the leverage or the reduction in debt, share buyback, all these type of things that you can have a look over history inside the balance sheet of the company. So that's all the items that we are looking at, qualitative, quantitative aspects of what is traditionally defined as quality. And with this approach, this bottom-up approach, we are able to find quality companies in every sector, even these sectors that are supposedly of poor quality. So we have seen quite a strong correction for large cap growth stocks during the last 12 to 15 months after a big rally and really an increase in valuations from mid-2021 until more or less Jay Powell's speech in November 2021. And since then, we have seen a sharp correction in the valuations of these companies. Mostly the valuation have corrected in parallel with the rise in interest rates, which is perfectly normal. That's pure math. And that's logical when it comes to the measurement of valuation. But do they have corrected enough? We talk about the big boys, Microsoft, the Amazons of this world. It's difficult to say, and we have to take case by case. Some of these companies still trade at very expensive levels in the current interest rates environment. When interest rates were at 0%, I mean, you could just give any kind of multiple for these companies. Today, with normalized interest rates, I would say US 10 years hovering between 3.5 and 4.5%, 25 times earnings or 30 times earnings, that could have seemed logical 2 years ago. It's difficult to defend this type of multiples in a rising interest rates environment, or at least in a higher interest rates environment. And so you have to take case by case. Some of big names, Alphabet probably now trade at reasonable levels, but added to the valuation pressure, you have also the business pressure that we have seen. The reports from Alphabet, for example, or Meta showed that there are some margins pressures, pricing pressures, and so it's difficult to say that as a whole, the large cap growth sector is now attractive. You have really to take case by case, and then you can find opportunities. But for some companies still in that space, valuations are way too expensive considering the new environment in which we are. So we haven't changed much our portfolio during the last 2 years. I mean, the names that we had 2 years ago are still there. We have a large cap growth, we have large cap, more cyclical companies. Once again, it's just a question of having a blended approach that helps us navigate in this very complicated market environment. We have absolutely no clue where interest rates are headed, and so we want to keep this very balanced approach, and we will have pockets of the portfolio that will sometimes underperform, but that would be compensated by the very good performance probably of some other pockets of the portfolio. For example, we have this year, unexpected contributors in the performance, like I would say Rio Tinto. Who could have thought that Rio Tinto would perform so well in a year of lockdowns in China and in a year of expectations for an economic slowdown? And whereas these factors are very well known, the company has been a very good performer, and so that's the type of thing we want to achieve through this portfolio, a blended approach that allows us to navigate correctly in different market environments. And so considering that, we don't foresee any significant changes in the portfolio, and maintain this balanced and blended approach, and take very much care of the valuations, being very disciplined, and that's all that matters for us. So this question is just the logical follow through after the previous one. A blended approach has this beauty of having a natural recycling inside the portfolio. As I said before, you have sometimes pockets of your portfolio that don't perform well, but the companies are good, the business is good, the margins are good, the valuation is okay, but for some reason, this pocket of the portfolio is not what investors want to have at some point. We maintain these positions, and you have other pockets of the portfolio that will perform extremely well at some point in this environment. And so that's what we really look for when we manage this fund, is the blended approach allows to navigate in very complicated market conditions. Once again, as we don't know what the economy will do, we know that there's an economic slowdown that is foreseen, but how severe will it be? We don't know. So will cyclical thrive? Will growth start to perform again? We have all these companies in our fund, and we believe that with our discipline in terms of valuations and in terms of quality, we should be in a position to maintain a good path of outperformance. It will not be as spectacular as it can be seen for a pure growth or a pure value fund, depending on who performs well. Is it growth? Is it value? We have both. And once again, having the good companies, the good quality companies in every sector, we believe that this is the right strategy going forward for probably, again, a bumpy ride ahead.